Hi, I'm your host from Fashion Avenue and welcome back to the channel. So, you've designed an amazing product, you've figured out manufacturing, and you're ready to take your brand global. That's incredible. But then you hit a wall, a really big, complex, number-filled wall called pricing. How much should you charge for your beautiful, ethically sourced silk scarves in Tokyo versus, say, Berlin? If you price it the same as you do at home, will anyone buy it? If you price it too low, will you even make a profit after shipping and tariffs and something called value-added tax? It's a question that can feel overwhelmingly complex, a dizzying spreadsheet of variables that seems to have no right answer, and in a way that's true. There isn't one right answer, but there are frameworks, strategies that successful global businesses use to navigate these treacherous financial waters. It's not just about covering your costs, it's about understanding culture, competition, perception, and the intricate dance of the global economy. It's about realizing that a price tag isn't just a number, it's a story you're telling your customer about value, quality, and your brand's place in their world. This is one of those topics that seems boring on the surface, but I promise you, it is fascinatingly, wonderfully complex. So today we're going to demystify international pricing. We're going to break down the major strategies from the straightforward to the sophisticated so you can make informed decisions for your own global ambitions. We'll explore how to calculate your baseline, how to read a foreign market, and how to use price as a strategic tool to build your empire, one correctly priced product at a time. This isn't just about math, it's about global business strategy, and it all starts with understanding your costs. Let's start with the most intuitive strategy, cost-based pricing. This is the bedrock, the foundation upon which many other pricing decisions are built. The logic is simple and reassuringly linear. You add up all the costs associated with getting one unit of your product into the hands of a customer in another country, and then you add a little extra on top, which is your profit. It feels safe, right? It feels like you can't possibly lose money this way, and that's its primary appeal. It provides a floor, a baseline below which you know you're operating at a loss. It's a method grounded in the tangible reality of your expenses, not the fickle whims of market demand. So, what goes into this calculation? Well, it's more than just the cost of the raw materials and the labor to assemble the product. You have to factor in the cost of shipping it across an ocean, the insurance you need in case the container ship has a particularly bad day, the import duties and tariffs that the destination country's government will levy, and any local taxes like a VAT or GST. You also have to consider marketing costs specific to that region, and even the cost of currency conversion. It's a long list, and each item adds another layer to your cost base. Once you have that total landed cost, you add your desired profit margin, say 20%, and voila, you have your international price. But here's the crucial limitation, the thing that makes cost-based pricing a starting point rather than a final answer. This method completely ignores the customer and the competition. It operates in a vacuum, assuming that just because you've calculated a price that guarantees you a profit, customers will be willing to pay it. What if your calculated price is double what local competitors are charging for a similar product? What if the average consumer in that market simply can't afford it? Your straightforward logical price might lead to exactly zero sales, which I can assure you is not a great long-term business strategy. It's a vital calculation, but it's only one half of the equation. If cost-based pricing is about looking inward at your own spreadsheets, market-based pricing is about looking outward, at the world. This strategy flips the script entirely. Instead of starting with your costs, you start with the customer. The core question here is not, what do I need to charge, but what will people in this specific market pay? It's a strategy rooted in empathy and deep research, acknowledging that the perceived value of a product can change dramatically from one culture to another. A luxury handbag that's a status symbol in one country might be seen as impractically flashy in another. Understanding these nuances is the key to market-based pricing. This approach demands that you become a bit of a cultural anthropologist and an economist. You have to conduct thorough market research. This means looking at what similar products, both local and international, are selling for. It means analyzing the average disposable income of your target demographic in that country. You might use surveys, focus groups, or data analysis to gauge consumer willingness to pay. You're trying to find the sweet spot, the price ceiling that the market will bear. Once you determine that optimal market price, You then work backward to see if you can produce, ship, and sell your product at that price, and still make an acceptable profit. The beauty of this method is that it aligns your product directly with local demand, maximizing your potential for sales volume and revenue. However, the risks are also significant. If you've misread the market, you could set a price that's too low, leaving a lot of money on the table, and potentially damaging your brand's premium image. Or, more critically, if the market will only bear a price that's below your total landed cost, then that market simply isn't viable for you with your current cost structure. Market-based pricing forces you to confront the harsh reality of whether your product and business model are a good fit for a given country, long before you ship a single item. So you've identified a new, promising market. It's competitive, full of established players, and customers are loyal to the brands they already know. How do you break in? How do you get people to even give your product a chance? One aggressive and often effective strategy is penetration pricing. The idea is to make an entrance that's impossible to ignore. You launch your product at an artificially low price, sometimes even at a small loss, to rapidly capture attention and, more importantly, market share. It's the business equivalent of shouting hello in a quiet library. People are going to turn their heads. The goal here is not immediate profitability. The goal is acquisition. You're trying to lure customers away from their usual brands by offering an irresistible deal. This low price reduces the risk for a consumer to try something new. Once they've tried your product and hopefully loved it, you've begun to build a customer base and brand loyalty. The strategy is built on the long-term vision that once you have a foothold, once you've penetrated the market and established a significant presence, you can gradually begin to raise your prices to more profitable levels. It's a classic bait and hook, but in the business world. Of course, this is a high-stakes gamble. First, you need deep pockets. You have to be able to sustain the initial period of low or non-existent profit margins. This isn't a strategy for a cash-strapped startup. Second, you risk creating a brand perception centered on being cheap. When you later try to raise prices, your hard-won customers might feel betrayed and jump ship to the next low-price leader. And finally, you have to be careful not to ignite a price war. Your low price might force competitors to lower their prices in response, leading to a race to the bottom that erodes profits for everyone involved in the market. Now let's look at the polar opposite of penetration pricing, a strategy known as price skimming. This approach is for brands that aren't just entering a market, but creating one. Imagine you've developed something truly innovative, a product with unique features and a distinct technological advantage. Think of the first iPhone, the first high-definition television, or a revolutionary new fabric in fashion. With price skimming, you launch this product at a very high price point. You're not trying to appeal to everyone. You're deliberately targeting a small specific segment of the market, the early adopters, the innovators, the connoisseurs. These are the consumers who are less sensitive to price and more motivated by having the newest and the best. They derive status from being the first to own something. By setting a high initial price, you do two things. First, you immediately cultivate an aura of exclusivity, luxury, and superior quality around your product. The high price itself becomes a signal of value. Second, and just as importantly, those high-margin sales to early adopters allow you to quickly recoup your significant research and development costs. You're skimming the most profitable layer of the market first, like cream off the top of milk. Then, over time, as the initial hype subsides, as manufacturing costs decrease due to scale, and as competitors begin to enter the market with similar offerings, you systematically lower the price. This allows you to capture successive waves of customers, the early majority, the late majority, and so on, each at a price point they are willing to pay. This strategy maximizes total revenue over the product's life cycle. The risk, however, is that the high initial price might alienate potential customers or slow adoption too much, giving competitors a chance to catch up and leapfrog your innovation before you've had a chance to move down market. Most of the time, you aren't launching a revolutionary product into a vacuum. You're entering a crowded field where customers already have plenty of options. In this scenario, one of the most common and practical strategies is competitive pricing. This isn't about ignoring your costs or the market's willingness to pay, but about making your primary reference point the price of your direct competitors. The fundamental goal is to position your product relative to others, using price as a key signal to the consumer about where you stand in the marketplace's hierarchy of value. The first step is a thorough competitive analysis. You need to identify who your key competitors are in that specific international market, and they might be different from your competitors at home. You then meticulously research their pricing for comparable products. But you don't just look at the number on the tag, you have to analyze the entire value proposition. Does their price include free shipping, a longer warranty? Is their brand perceived as more prestigious? Based on this analysis, you can choose to price slightly below your competitors to attract price-sensitive buyers, price the same to compete on features and quality, or price slightly above to signal superior quality or added benefits. This strategy is relatively safe and easy to implement, as it anchors your decision-making in observable market data. It helps prevent major pricing errors and keeps you in line with customer expectations. The downside, however, is that it can lead to a reactive rather than proactive business strategy. If you are always following your competitors' pricing, you may be limiting your own profitability. It can also lead to price stagnation or, in the worst case, a tit-for-tat price war if you and a competitor keep trying to undercut each other. It's a strategy that requires constant monitoring and a clear understanding of what makes your product different, beyond just the price. Our final strategy is a bit different. It's an internal affair, a conversation that happens within the walls of a single large multinational corporation. This is transfer pricing. It's not about the price a customer pays, but the price that one subsidiary of a company charges another subsidiary for goods or services. For instance, imagine your fashion company has a design house in Italy, a factory in Vietnam, and a distribution center in the United States. The Vietnamese factory has to sell the finished garments to the US distribution center. The price of that internal sale is the transfer price. Why does this even matter? If it's all one company, isn't it just moving money from one pocket to another? The answer is a big, resounding no, and the reason is taxes. Different countries have different corporate tax rates. A company might be tempted to set a very low transfer price on goods sold from a high-tax country, and a very high price on goods sold from a low-tax country. This would shift the majority of the profit to the subsidiary in the low-tax country, thereby minimizing the corporation's overall tax bill. This is, as you can imagine, something that tax authorities like the IRS in the US or HMRC in the UK are very interested in. Because of this potential for tax avoidance, transfer pricing is one of the most heavily regulated areas of international business. Companies are required to use the arm's length principle, which means the transfer price should be the same as it would be if the two subsidiaries were unrelated, independent companies. Proving this involves complex documentation and economic analysis. Getting it wrong can lead to massive fines, back taxes, and legal battles. So, while it's an internal pricing mechanism, it's one that must be handled with extreme care and transparency, as governments around the world are watching very closely. So from the foundational logic of cost plus to the strategic dance of competitive positioning and the complex internal world of transfer pricing, it's clear that setting a price is so much more than just picking a number. Each strategy we've discussed is a tool, a lens through which you can view the global marketplace. The right strategy for your brand won't be a one-size-fits-all solution. It will be a dynamic blend, a hybrid approach that adapts to different products, different markets, and different stages of your company's growth. It's a constant process of calculation, research, and recalibration. What I hope you take away from this is that pricing is one of the most powerful storytelling tools a brand has. It communicates your confidence, your values, your understanding of the customer, and your place in the world. Getting it right can unlock incredible growth, while getting it wrong can stop a great product dead in its tracks. It requires you to be both a meticulous analyst, poring over spreadsheets and cost structures, and a curious explorer, seeking to understand the subtle cultural and economic currents of a new market. It's the point where the art of brand building meets the science of economics. Thank you for joining me on this deep dive into the world of international trade pricing. The world is full of complex things, but by breaking them down, we can begin to understand and master them. Don't forget to like and subscribe for more explorations into the business of global enterprise. And as we say here at Fashion Avenue, stay curious, stay informed, and build something the world has never seen before. Thanks for watching. Thanks for